before the break we were talking about spread strategies, and we discussed the vertical spreads using call options, bullish vertical spread using call options, and we discussed the justification of using a spread strategy compared to a long call, justification of using a bullish call spread compared to a long call, and we justified it on the count that it is basically a game of perception. If the perception of an investor is such that he believes that the stock price is going to move within a certain domain, within a certain region, then he can very well take advantage of that perception and write a call beyond the level at which he expects the price to go, and thereby reduce the cost of setting up of the strategy. There are many other spread strategies of similar nature. We have got bullish spreads using put options, we have got bearish spread using call options, bullish spread using put options, and then bearish spread using put options as well. Briefly touching on a bullish spread using put options. In the case of a bullish spread using put options, we buy a put option at a strike price Ka, a maturity T which is constant for both the options as I have been emphasizing, and a price and obviously a premium Pa, and we sell a put B at a price K, strike price Kb, maturity T, and the strike prices and the premium is Pb with Ka less than Kb. And as you can see, the diagram is very similar to the diagram which we had for a bullish call spread. However, the difference is that in this case, this particular portion which was in the previous case the difference of the exercise prices now becomes the difference of the premia, and because Ka is less than Kb, the premia on Ka, Pa is less than the premia on Kb, that is Pb, and therefore, because you are buying the option A, this is the amount that you are paying, this is an outflow, and this is an inflow, and therefore, we make a certain amount of profit on the strategy, and this represents that particular region of profit. So, the rest of the analysis is more or less similar, and similarly we can construct a bearish put spread by inverting the bullish put spread. In other words, we buy the put option with the higher strike price and we sell the put option with the lower strike price. Now, let us talk about a butterfly call spread. This is very interesting. In the case of a butterfly call spread, we have three types of options involved in this strategy. We buy a call at Ka, maturity T, and with a price with a premium Ca. We buy a call C with a strike C, and maturity is the same for all the options. All of these are vertical spreads, and the premia is C of C, and we sell two calls at the midway price between Ka and Kc. So, I repeat, buy one call at Ka, buy one call at Kc, and sell two calls at Kb, where Kb is precisely midway between Ka and Kc. Now, in this case, if you look at this diagram, you have to split up the entire spectrum of possible stock values on maturity into 0 to Ka, Ka to Kb, Kb to Kc, and Kc beyond Kc to infinity. What happens in the various cases? If St is less than Ka, then none of the calls will be exercised, because the St, the stock price happens to be less than the strike prices of all the call options. Now, if Ka is less than St, that means St is greater than Ka. If St is greater than Ka, then option A will be exercised, none of the other options will be exercised, B and C will lapse. Similarly, if Ka is less than Kb, that is given, and Ka is less than Kb is less than St. In other words, St is greater than Kb and St is greater than Ka, obviously, because it is greater than Kb. In that situation, option A as well as option B both will be exercised. Remember, there are two options with strike price B and both of them are short. And then we have Ka less than Kb less than Kc less than St, where St is greater than all the strike prices. In that scenario, all the options will be exercised, all the calls will be exercised. The call A, the call C are long and the two calls B are, both of them are short options. This is the table showing the payoff in this case. What do we have? In the long call A gives you St minus Ka, St minus Ka, St minus, in the three cases. Only in the one case where St is less than Ka, this option is not exercised, otherwise this is exercised in all the other cases. The two short options B are exercised in two instances where St becomes greater than Kb and of course, if St is greater than Kc as well, and the long call C gets exercised if St becomes greater than Kc. Now, you look at this. If you look at the payoffs of the aggregate payoffs of all the options, we have St minus Ka, and remember Ka is less than St, Ka is less than St and the payoff is St minus Ka, therefore, this is greater than 0. If you look at this one, it is minus St plus 2 Kb minus Kc, but remember this 2 Kb minus Ka is equal to Kc. So, it can be written as Kc minus St, which is again greater than 0, because Kc is greater than St. You can have a look at this particular inequality. And similarly, in this case, in the last case, the aggregate payoff is 0. So, what do we infer? We infer that the payoff in the first and the last cases is 0, and in the intermediate cases the payoff turns out to be positive. In other words, there is no situation whatsoever in which the payoff on maturity arising from this option turns out to be negative. All payoffs are either 0 or positive. Whatever may be the respective probabilities, the expected payoff must therefore be positive. I reiterate, the payoffs, you can look from the last row of this diagram, the payoffs 0, greater than 0, greater than 0 and equal to 0. In other words, the payoffs are invariably greater than equal to 0, and therefore, when you work out the expected values taking any probability distribution for the stock prices, you are going to end up with either a 0 or a greater than 0 figure. What does that mean for the cost? That means that the cost of setting of this strategy must be either 0 or greater than 0. And in other words, you can also put it this way, the cash flows have to be negative at this point t equal to 0, because the cash flows at this point, the expected cash flows at this point are either 0 or greater than 0, depending on the probability distribution that we attach to the STs. This is the diagram of the payoffs between 0 and Ka, because no options are exercised. So, there is no, please note, this is payoff, this is not profit, this is payoff, and between 0 and Ka there is no payoff, because none of the options are exercised. Between Ka and Kb, option A is exercised, we are long in the option, so we have a profit. Between Kb and Kc, we have two short options, we have one long option, and therefore, there is a residual short option which is being represented by the negative 45 degree line or a negative slope of 1, and then we have the next point where again the payoff turns out to be 0, because all the options are exercised, two long calls, two short calls, the net payoff is 0. I reiterate, this is the payoff diagram, this is not the profit diagram. Now, as I mentioned earlier, because the payoffs is either 0 or greater than 0, so this expression should be greater than 0, or in the worst case limiting scenario. In the limiting scenario, for example, if you say that the probability of the stock price, the entire stock price probability is between 0 and this region, that is more or less an academic example, not really a realistic situation. The stock price remains between 0 and K, let us say 0 and Ka, then the worst case scenario this can be greater than equal to 0, but otherwise it would be greater than 0, because the payoffs on maturity happen to be greater than 0. Similarly, we can construct butterfly spreads with put options. We have talked about butterfly spreads using call options. We can also have short butterfly spread. This was an example of a long butterfly spread. You can simply reverse the entire scenario and you can have a short butterfly spread. You can also have butterfly spreads with put options, long butterflies with puts and short butterfly with puts. The analysis is absolutely similar, absolutely parallel. Now, we come to a very intriguing case, intriguing combination of options, which is called a box spread. A box spread consists of a bullish call spread between two prices Ka and Kb. There are two strike prices Ka, Kb, same maturity, options are European. Please note this, it is very important, European options. So far all that we have been talking about are European options. So, the box spread consists of bullish call spread, two prices Ka, Kb, Ka less than Kb, same maturity T and European options. Ca and Cb are the prices of the two options, and we have a bearish put spread. There are two put options, the short put X and long put Y. So, in total there are 4 options: long call A, short call B, prices Ka and Kb, Ka is the long call, Kb is the short call, and then we have bearish put spread, short put at Ka, short put X at Ka and long put Y at Kb. So, there are 4 options. The combination of these options, let us explore what does it give us. Long call A, now we have two cutoff points Ka, Kb. So, we need to split up the entire spectrum of stock prices into 1, 2 and 3 regions, 0 to Ka, Ka to Kb and then beyond Kb. So, let us start with 0 to Ka. Long call A will not be exercised because the strike price is Ka and the stock price is lower than the strike price. Short call B will not be exercised. Why? Because the strike price is Kb, the stock price is St, again it is lower than K, because it is lower than Ka, it has to be lower than Kb. We are having Ka is less than Kb, please note that. So, because Ka is less than Kb, so if something is less than Ka, it is automatically less than Kb. Short put X, now this would be exercised. Why? Because this is at strike price, this is a strike price Ka and Ka is smaller than St is smaller than Ka and it is a put option, therefore, it will be exercised and it is short. So, there is a minus sign here and the payoff is going to be Ka minus St. And the long put is also going to be exercised because it is exercisable at Kb and the stock price is lower than Kb and therefore, it would be profitable to exercise the long put Y and the payoff that you will be getting is Kb minus St. The aggregate payoff, if you look at this, turns out to be Kb minus Ka. Now, let us look at the second scenario when Ka is less than St is less than Kb. Now, long call A is exercised because the strike price is Ka and St is greater than the strike price, therefore, call option becomes operative, call options become profitable and therefore, you exercise the call option A and you get a payoff of St minus Ka. As far as short call B is concerned, that will not be exercised because your price, the stock price is lower than the exercise price, therefore, call options do not come into play and this will be 0. Now, short put X, now this had a exercise price of Ka and now the stock price has gone beyond Ka, it is more than Ka. So, the put option becomes inoperative, it does not give you any payoff, but the other put option is still operative. Why? Because the stock price is less than KB, which is the strike price of the option Y. So, Y remains live, Y remains exercisable, and it will be exercised, and it will give you a payoff of KB minus ST. So, aggregating all these 4 quantities, you end up with KB minus KA. Doing the same thing for the next situation, where KB is less than ST, these both the call options become live, become exercisable, and shall be exercised. Both the put options will lapse, and you again have this. Now, it's the last row makes very interesting reading indeed. KB minus Ka, KB minus Ka, KB minus Ka, and incidentally KB minus Ka is also greater than 0. So, in all cases there are two things. Number 1, the payoff is the same. Number 2, the payoff is independent of the price of the underlying, and in fact number 3, the payoff is positive. 3 important consequences. Number 1, I repeat, number 1, payoff is the same in all the 3 cases. Number 2, the payoff is independent of the stock price, it is independent of ST, and number 3, the payoff is positive. This is very interesting, because what does it mean? It means that whatever is the state of the evolution of the stock price on maturity, you are getting the same payoff. In other words, it is a risk free payoff. These variations in stock prices represent the risk. If variations in stock prices do not impact the payoff of our strategy, that means our strategy is risk free, and because our strategy is independent of the price of the underlying asset, this has to be classified as risk free. Now, that being the case, the investment that goes here must yield a risk free return on maturity equal to these quantities. Putting it the other way around, the present value of this quantity calculated at the risk free rate for time t must give me this quantity. I repeat, the present value of this quantity KB minus Ka calculated at the risk free rate must give me this. Now, what happens if it is not so? What happens if the present value of the payoff from the box spread is not equal to the cost of setting up of the strategy? What happens if the cost of setting up of the strategy is low? If the market value of the box spread or the cost of setting up of the box spread is lower than what it should be, arbitrage will immediately come into play. How will arbitrage take place? If the price is low, you buy the box spread and you take the payoff at the risk free rate on maturity. In other words, how will you buy the spread? You will buy the spread by taking long positions as per what we have just discussed, long positions in call A and put Y, and short positions in call B and put X. This combination is called a long box spread. Please note that this is a long box spread. So, if the box spread is being traded at a lower price in the market, do this strategy, take a long position in this, and you get a risk free profit through the process of arbitrage. And if the market price is too high, simply invert this strategy. Instead of taking long call at A and long put at Y, you take a short call at A and a short put at Y, and the other two options would be long options. So, that is how you can do arbitrage if the box spread is not priced according to the risk free rate. Now, we come to the horizontal spread. We have been talking about vertical spread so far. Vertical spreads, as I mentioned in the beginning, are relatively easy to analyze, because they have a maturity which is common to all of the constituents of the strategy. constituents of the spread. However, in the case of a horizontal spread, we have a slightly different situation. We have the same exercise price, but we have different maturities. One option has a maturity which is shorter, the other option has a maturity which is relatively longer. Now, let us say we have two options. We take a short position in option A and we take a longer position in option B. The maturity of this is T A and the maturity of this is T B. So, maturity of option A is T A, maturity of option B is T B, and obviously let us say the price of option A is C A, the price of option B is C B, and let us assume that this is short, and this is long. What we do now is we look at the payoffs diagrams of the strategy of this strategy, which has a different maturities, but same exercise price. At this point, at the end of T A, when the option A, when the shorter option matures, but the longer option continues to be live. Shorter option A is maturing, option B is live. Before we proceed further, let me emphasize one thing, that longer the maturity of the option, the more costly it is. Longer the maturity of the option, the more costly it is, because it has to deal with greater uncertainties, greater volatility of the underlying asset, and therefore, more costly it becomes. Therefore, in this case, because you are long in option B and B is the longer maturity option, you will be paying a higher price than you would be recovering on the shorter option, which has a shorter maturity and would be cheaper. In other words, the inflow that you get by writing this option C A, would be less, and the outflow that you incur by buying the option B, which has a longer maturity, would be more. Therefore, C B minus C A is going to be positive. The net cost of setting up of this strategy is going to be positive. The net cash flow is going to be negative. The cost is positive, cash flow is negative. Now, let us do the analysis. Let us start with both the options being way out of the money. Let us say ST, since we are dealing with call options, let us say ST is very much less than K. K is the strike price, STA is the time. So, STA is very much less than K. Now, because STA is very much less than K, the immediate fallout is, and TA is the maturity of option A, therefore, there would be no payoff from option A. The short maturity option will lapse on maturity, because ST is very much less than K. What happens to B? A is not giving me any payoff on maturity if this situation arises. Now, what about option B? If this situation arises, as far as option B is concerned, the investor perception is likely to be that on maturity of option B, there is a very small chance that option B would be exercised. Why? Because the gap is so gigantic that people would not be expecting this gap to be made up and overridden to the extent that the option B becomes profitable at the point in time at which it is going to mature. In other words, the general perception embedded in the market would be that the option B is likely to expire out of the money, and if that is so, then we will have more or less as option B also giving you negligible payoff. B also, A comma B both give negligible payoff in this region. Now, let us look at the other way around. If ST A is much greater than K, now what happens? as far as option A is concerned, it is quite straightforward. You will get a payoff of STA minus K. So, there is no problem as far as option A is concerned. You get this payoff STA minus K. What happens to option B? Now, if STA is much greater than K, then the intrinsic value of STB is of option B is STA minus K as well. And if this differential is sufficiently large, then it's very much likely that this intrinsic value could be realized by selling this option in the market, because the perception would be that the option B would also expire in the money and it would give you a similar amount of payoff on maturity. And that being the case, the payoff that you are going to get from option B or selling option B unexpired is going to be more or less equal to this, more or less, or pretty close to it. That, what does that give us about the total payoff? The total payoff again becomes more or less negligible. This is, remember, this is short, this is long. So, the total payoff will again become negligible in this region. So, what have we seen so far? What we have seen so far is that if the stock price on the date of maturity of the shorter maturity option is either too low, so that the options are completely out of the money, or too high, so the options are very much in the money, the payoffs are more or less negligible. What happens if ST is close to K? This is the most interesting scenario. Now, if ST is close to K and option A matures, then you are getting a payoff of STA minus K. STA minus K, which is a small amount, approximately 0. What about option B? When you go to the market and try to sell option B. Now, in this situation, when ST is very close to K, STA is very close to K, option B will command its maximum value. Why? Because the investors would be perceiving that the stock price could move in either direction, and as a result, the uncertainty attached with the stock price finishing up in a particular direction would be the maximum, and that uncertainty translates into time value of the option, and that is what gives you more worth of the particular unexpired option. And in this case, because this option B is unexpired, it is likely to continue for some more period of time before it reaches its maturity. In that case, this particular option, option B, is likely to be at its peak price. And that being the case, we in this situation, ST or rather payoff of option B would be greater than payoff of option A, and you would have a peak of profit around K. So, this is the explanation of this particular calendar spread under the given circumstances. This is called a long calendar spread. A calendar spread where the shorter maturity option is short, the longer maturity option is long, is called a long calendar spread. And if you look at it carefully, the payoff diagram or the profit diagram is more or less akin to the butterfly spread, very much similar to the butterfly spread, where we have a peak at an intermediate point and we have losses or zero, nearly zero payoffs at the two extremes of the stock prices. So, we can also construct calendar spreads using put options, just like we have call options. Just one example to conclude this particular topic. A box spread consists of 4 options. This can also be viewed it as a bullish call spread and a bearish put spread, we can also view it as a long forward position and a short forward position. Let us see how. It is very interesting. Bull call spread is this, we have talked about this. Bear put spread is this. So, the box spread is equal to this plus this, and now I simply rearrange this equation and I write A and X together and B and Y together, and these two quantities, this quantity and this quantity, turn out to be giving payoffs similar to forward contracts. Let us see how. Look at this. This A is a call, you will recall that A is a call option. So, long call, and this is what the X was, a short put. So, long call and short put, this is a short call and this is a long put. Let us look at this one first, long call and short put, long call and short put. Okay. So, T equal to capital T, again we split it up into two partitions, S t less than K, S t greater than K. Long call gives you a payoff here, short put gives you a payoff here, and as you can see the total payoff is S t minus K, which is the payoff of a forward contract. So, this is a long forward contract, and the other part, this part is a short forward, this is a short forward, this is a long forward. So, with this we conclude the discussion on trading strategies. Now, I propose to take up pricing of options, which would be the next topic. Thank you very much.